Welcome to the Alaska Realtor live stream. My name is Jamin Goecker, and my mission is to help you to build an intentional and significant legacy for yourself and your family by coaching you in real estate. And the purpose of this live stream is to answer the questions you have as you're thinking about moving up here to Alaska and to bring people in who have the perspective in order to help you do that. And in order to help me accomplish that mission tonight, I'm actually going to be joined by Amanda Jensen with First Rate Financial, and she's going to be answering the questions that people have as they're moving here to Alaska. So, Amanda, thank you for joining us.
Of course. Thanks for having me, Jamin.
All right. So before we get started, let's go ahead and do this. Why don't you go ahead and tell everyone, a little bit about your Alaska story and, just kind of your Alaska story and I guess what you think about Alaska. How about we do that? Pretty softball.
I grew up in Anchorage and I moved to the Valley and I fell in love with the Valley. I love the Valley for the fact that I can get on my snow machine and ride. I can get on my four-wheeler and ride wherever I want. The Anchorage is great, but it's a little bit more restrictive in the sense where you can't do stuff like that. And I would have to say that Alaska is home for me. I've visited other states and other, countries for that matter. I enjoy their beauty, but when I land in Alaska, I feel at home and at peace because it's something about being surrounded by the mountains and everything for me that I absolutely love. There's so much space out here where you can get lost in the woods and do things with your family. When we go out, we are boaters, so we love going out of Whittier, and there's so many coves out there that you can just get lost. And it's so surreal when you're out there because sometimes you feel like you're the first person that's actually hiked that mountain, which you probably haven't, but you're just so far out from civilization. It's amazing. It's an amazing feeling, and hands down, Alaska is one of the most favorite places I could ever imagine living in. So, but yeah, I would say that's pretty much sums up my story. And I live in the Valley now and absolutely love it out here, raising my family. And with, my kids growing up, hopefully they'll want to stay in Alaska too. But there's nothing really tying them down here. So if they move, I get it. A lot of my other family has already moved. So, yeah.
And outstanding. I mean, that's always kind of the trick, I guess, going from generation to generation, whether or not the kids are going to stay around after they've graduated. Sounds like the age-old problem.
Yeah, exactly. But we always tell them, this is home for us. And I know eventually, like my parents, they moved to Arizona, and my dad was born in Haines, and they were tired of shoveling snow. And he always jokes, he's like, "You're going to be a lifer." And I was like, "Probably, yep, definitely going to be a lifer. Maybe find a house when we're old and it's hard to shovel snow to snowbird too, but always come back to Alaska for me, for sure."
Man, that's awesome. All right, so let's go and do this. And real quick, just some housekeeping things for the live stream. As you guys know, these live streams are always as helpful as we get engagement from you. So we have the expert right here in house and answer a lot of the questions you have about getting pre-qualified, whether you should be absolutely terrified about the upcoming market here in Alaska, and or if this is going to be the best year ever for you to be jumping in. So we'll be answering some of those questions here, but you got to help us out and throw questions, comments, concerns, objections, whatever you got into the comments section, so we know how exactly, what questions we need to be answered for you. And on that note, we do have a question that came in from Rosa on the community post I put up on YouTube, and this is a question she had. So I would like to know. I would like to know how consistent contractual income bonuses play a factor for qualifying income. So, yeah, Amanda, what would you say to that?
Yeah, Rosa, that's a great question. So when we're looking at bonus income, a lot of the lenders and the investors, so whether you're looking at FHA, conventional, USDA, VA, those types of loan programs, they're going to be looking for at least a 2-year minimum to come up with an average. And so whether it's contractual, whether it's fluctuating to the point where maybe it's not as consistent, they're still going to want that 2 years of history to show an average of what you're receiving, whether that's bonus income, commission, whether that's overtime, that type of stuff.
Yeah. Now that definitely makes sense. All right. So let's go and jump into our planned programming here. And again, folks, if you have questions about lending, this is the time to go ahead and get them answered. We have some pre-planned questions that I think usually hit most the basic, or most the foundational basic stuff people have. But make sure if you have any questions, you throw it into the comment section so we can get those answered for you.
Absolutely.
All right. So question number one. How are you talking with people about the upcoming market? I mean, I know that interest rates and only play like one variable into the whole picture when we're talking about the real estate market and the lending market. But, what are you telling people right now about the upcoming market for the year 2024?
So a lot of people ask me that question. And so based on data and where we're at, we're predicting that the market's going to continue to improve. There is a graph, I know, Jamin, that you have it, that shows kind of where we were ending off the market. And you can see in this graph that it's right here. You're going to see how market has been coming up. And it's not going to be a straight line up. You're going to have good days and bad days. But that green line in that graph shows, like, basically you're going to see it coming up and the market coming up. When the market comes up, rates come down. So this was just a few days ago, and markets already improved over the last couple of days. And so we're going to continue to see, as more data comes out, how the market's improving. Just yesterday, the Feds conducted their 2-day meeting, releasing the statement following from Jerome Powell press conference that they kept the rates unchanged, and that they've acknowledged that they've expected, like, it's been better than they've expected with the economic activity. And so that's good news for market. As, like, again, they predict, a lot of the experts predict, with the changes that we're seeing right now, that market is going to continue to increase, which will bring those rates down. And people are going to have an opportunity to refinance later that have already bought homes. Nobody has that crystal ball, though. So there's a lot of things that could happen within the market that could make us trip or fall. But basically, on most of the data, we're going to continue to see rates come down.
So you mentioned it. I mean, no one's got the crystal ball. We don't know exactly when or by how much, but should people still be holding out for like the 2.5-3% interest rates that they had, a couple of years ago? Is that realistic at all anywhere in the near future? Or I guess, should we be happy with what we're getting and just roll with it from there?
Definitely be happy with what we're getting now from where we were. 2.5%, 3% is not really in anybody's line of sight. They're thinking more towards like low fours, low fours, low fives for interest rates. But again, nobody with that crystal ball. When rates were down in the twos and almost hitting like the ones, that wasn't really good for the economy anyways. So I mean, it was just a little bit looking at everything. That's kind of what they're predicting. Like for government loan programs, that we might see low fours, and like conventional loan programs, maybe depending on people's credit and everything, like high to low fives. So
yeah. What does that do to people's buying power?
So, I mean, depending on like the percent of somebody, purchasing a $300,000 house, that's a percent higher, that could change their buying power, significantly. We're looking at maybe like 50 to 30,000.
Yeah, no, that's absolutely huge. And I mean, that's like 1%. And for some people, it really kind of depends on, kind of the price range that they're in as to how big of an impact that is going to make. I mean, there are some people where they're just kind of on the line whether they can or can't do it. And that 1%, or, coming down to kind of that upper four, lower fives, just as a complete game changer.
Mm-hmm. Yeah, for sure.
So one thing I did want to share with everybody, though, just to kind of give you an idea as to what's going on with kind of the overall health in the market here. This is a chart showing what the what's going on as far as the inventory in Anchorage, Alaska, and this is going to be the largest market in Alaska. So in a way, it's kind of a canary in a coal mine for us in a lot of ways. Can everyone see the chart here? The program's being a little slow tonight. So is it? Can you guys see it? You can see it. Okay. Well, give me just a second. Let me pull this up on my end. All right. So we are looking at chart number 1 here. This is just looking at the inventory of what's available in Anchorage. So you see that for the month of January for 2024, we have slightly more inventory than we did for the year before. So it was 188 last year, and now it's 198, which that's a little bit better. But if we look to like the pre-COVID times, about 2019 and back, normally we'd be seeing closer to about 550 or close to about 600 properties on the market for about this time. So you can see how that's it's a slight improvement, but we still got a ways to go.
Mm-hmm.
Yeah. Now looking at the second graph here, this is going to be the number of properties that have actually sold, and we see even with the inventory still being as low as it is, there's about 91 properties that closed for the month of January, and now it's about 109 for this year. So we're still seeing the demand out there. But I mean, ultimately, we can't sell what's not there. So that's we can only keep defying the odds there for so long. Now, the thing I know everyone always wants to know is what's going on in the average sold price. So let's go ahead and take a look at that. So, in the average sold price for Anchorage for single family homes, we see that this time last year, the average sold price for the month of January, which that's kind of year to date because that's all we have really right now, it's about 435,000, and this year it's about 456,000. So we do see that the average sold price is continuing to go up, and I mean it's realistically probably not going to be going down anytime soon, just because the inventory is remaining so low. And one thought I've really had looking at this market is what happens when we suddenly have like a drop in the interest rates, kind of like what you're talking about, and we have this smaller pool of houses out there from what we had before. So go ahead.
No, I was going to say that's kind of what I stress to people right now, because there's so many people on the fence that want to wait until they see those rates drop to really pull the trigger. And my mind flashes back to like even just a couple of years ago, 3 years ago, when rates did get low. There's not a whole lot of inventory out there. So what happens is there's going to be a lot more buyers flooding the pool of low inventory. And then, I mean, Jamin, you can speak to this, like the prices of homes end up going up.
Yeah, that really is kind of the concern for me, that it's actually less inventory than what we had before. So let me pull this up again here.
Mhm.
Okay, give this just a second. I'm just going to assume you guys can see it, but give me a second to pull it up in my file. Yeah, so looking back at about that 2020, we'll say 2021, back when the inventory was pretty low, and I mean it was pretty intense. It was still about approximately 300 homes were on the market in Anchorage. And you can see how if suddenly, we're hit with a high demand again, it just becomes a slugfest very quickly. And that's not to scare people away, but it's also really to just kind of stress that waiting for the perfect storm to happen, where you've got low interest rates and you've got high inventory, and you're going to be able to swoop in and get like this incredible deal that's like all this money off. I am just not seeing it. As always, this really does look like a scenario where you kind of have to just pick your pros and cons with the market. You can wait, and it's still probably going to go up in the meantime, because I'm going to pull up this graph again one more time just to show it to you for the average sold price. We see that average sold price this year for 456, and back in about 2019 it was about 348,000.
Yeah.
So you can definitely wait as long as you want to. I'm just not expecting anything really different from that in the near future.
Yeah.
But folks, I've kind of gone on a little bit. I know a little bit heavy on the charts and everything. Do you guys want to see everything for the Mat-Su Valley? We good? Want to keep moving? Let me know in the comments section down below. But yeah, Amanda, that is definitely what I'm telling people, at least on my end, as we're looking here, is you just, probably the best thing is just lock something in and then refinance if the rates do come down, and just watch comfortably from the sidelines as everyone else loses their minds.
Yeah. Well, and that was so many people that waited on the sidelines for rates to come down, and they were the lowest they had been, and they still were waiting. I'm not really sure for what. And then when prices of homes shot up and then rates started to slowly creep up, they're like, oh, we're going to wait for them to come down again. But when you look at that, I know I had a chart in regards to the spread in net worth from renters to home buyers, and it's changed drastically. So I'm encouraging everybody, if you're on the sidelines, that now is the time to buy, secure the home, and then you can refinance when rates come down. Don't wait to buy until rates come down, because nobody has that crystal ball. And if rates don't come down, you're still securing a property that's going to continue to appreciate you, for yourself and for your family. So.
Yep, absolutely. All right, so let's jump into some more loan stuff here, because I know that's what the people want.
Yes.
So what are the pros and cons of the different loan types? I mean, if you could give like your top 3 loan types, what are they, and what are the pros and cons?
So I would definitely say, when I'm looking at the pros and cons, when I'm dealing with somebody specific, everybody's situation is so vastly different from somebody else's. So it's not necessarily a one size fits all. But however, I will say, like, if you're a first time home buyer, there's conventional loan programs out there, the Home Possible, Home Ready, where they have a low down payment, 3%, lower interest rates, lower mortgage insurance. But then you also have FHA, which is 3.5%. That's mainly meant for somebody who maybe doesn't have like a strong credit score, or they have a higher debt to income ratio. Conventional, I would say we're good under 50% typically if you have a higher credit score, under 50% debt to income ratio. And then for FHA, if you're exceeding that 50%, debt to income ratio, FHA is probably a better option for you if you're trying to fit in your family into a certain size of a home. And with that lower down payment, the cons with an FHA is you're going to have the mortgage insurance for the life of the loan until you refinance out of that loan program. Unless you put 10% down, then it's going to only stay on the loan for a certain period of time. And then they also have the upfront funding fee that gets financed into the loan amount. So with conventional, you don't have the mortgage insurance for the life of the loan, regardless of how much you put down. And there's no funding fee that gets financed. And then for some people, they might fit into like a USDA loan, which is a zero down loan program. Those are very restrictive in the sense of their debt to income ratio. They don't like to see them go over 41% back end of the debt to income ratio, 29 on the front housing to income ratio. And those ones are basically, if your family is a certain household size and your income is exceeding that income of what USDA allows, then you might not qualify for that loan program. So all of the loan programs are amazing. It's just a matter of tailoring it to your family's needs and I like to look at all the different aspects and then providing that to everybody so they can see and choose for themselves what makes the most sense.
Yeah. So, I mean, it definitely, it really depends on what it is that you're wanting to do and, for the specific environment. I mean, even for something like investing for me, like I went and purchased like my first property with an FHA loan. And the great thing about that, I didn't have to put a whole lot down and the interest rate was really low on it.
Mm-hmm.
That was the really awesome part. And it has been a saving grace, let me tell you. And also, one thing to keep in mind with that one is I did have the PMI, the private mortgage insurance that's just kind of on the loan for the duration. So, kind of a small con compared to what I'm getting, but it's just being aware that there are kind of the pros and cons, and it's got to be tailor fit to what you're doing.
Yeah.
Now we do have a question coming in here from Rosa on Facebook. So she said, I've been reading, it's becoming a trend that people are buying with more than one party / individual on a mortgage to buy a bigger home and offset the rates. Could you expand on this?
Yeah. So, I mean, most people, as far as like the rates itself, those are going to be set by, there's so many different factors that go into building a rate. Your loan to value, your loan type, your debt to income ratio, your credit score, which on mortgages, they're going to go off the lowest middle credit score, no matter how, like if you have 3, 4, 5 people on the loan, somebody could have an 800 credit score, but the person that has a middle FICO of 659, they're going to use that. They're going to use the lowest middle credit score. But there are some people who are having maybe grandma, parents that they're looking at buying a duplex or a larger home with, that they're going to live in the property with the kids, adding them to the application to help lower that overall debt to income ratio. If the kiddos or their kids, jobs aren't really enough to support the larger home purchase.
Got it. Yeah, that's really a scenario that I could see that would make sense if you have kind of a multi-generational home and you're just trying to buy like some kind of a larger property for everyone to be in.
Mm-hmm.
I mean, that's really kind of the scenario that I can think of there.
Yeah.
Rosa, let me know in the comments section down below if that answers your questions. I mean, we want to try to make sure we're answering those as best we can.
Yeah.
All right. So Amanda, what are some misconceptions people have about the pre-qualification process? And I'm sure this is something you run into quite frequently because people tend to avoid going and actually talking to the lender. So, what are some misconceptions that you see?
I would say that a lot of people think that everything is set in stone when they come talk to me. And so they try to go on their own to clean up their credit or do certain things that they think will help their application better. Oh, I need to do that. But they don't need to. A lot of I would say is like the biggest misconception. I love it when people come apply as everything is, because a lot of times when people try to work on their credit and then apply, it's not necessarily going to hit the credit report depending on the creditor, because those can take anywhere from 30 to 90 days to hit their actual credit report to reflect the changes that they just did or made, whether they were paying down credit card debt or paying, an installment loan off. And the reason for that is because the creditors are paying the credit bureaus, which credit bureaus are a for-profit company. That's why when people apply for mortgages, they typically get a lot of phone calls and crazy calls from other lenders saying, hey, I noticed you're applying for a loan, because they sell those as trigger leads to other mortgage companies. But so they're a for-profit company. Those creditors, when they pay the credit bureaus to report this information, they a lot of times batch that information. So sometimes most creditors don't report every 30 days. They might report every 60 to 90 days, and they'll get all the information and the data from the last couple months and then send it to the credit bureaus to have them updated. And we can simply do that with what's called a rapid rescore. we get a letter from the creditor saying what they actually did, and we can send it to the credit bureaus on their behalf to basically get it expedited and dealt with within typically a week versus waiting. So,
Gotcha.
yeah.
Okay. And let's see, what things do buyers worry about that usually turn out not to be an issue?
Um, I would say some of the things that buyers worry about that turn out not to be an issue is, whether they have a low credit score or they don't have fully the amount they need for the down payment or closing costs. They're trying to get all of that in line and perfect, whereas they might know that there's certain loan programs out there that'll help them with the down payment or down payment assistance programs. So they don't have to scrape and try to save up, $10,000 or more dollars, when there's those programs out there where they don't have to bring necessarily a down payment. And a lot of times, depending on how much they can qualify for, they might be able to wrap those closing costs into the purchase price and have the seller pay for those.
Hmm. What are some example of some of those programs that people might not be aware of? Because I mean, that definitely is something there for quite a few people as they're just worried about not being able to come up with the cash to put down for down payments. I know that's very prohibitive for a lot of people. What are some programs that are used in order to assist people with that?
USDA is a zero down loan program. That's a big one, that sometimes works great for people. Like I said before, they are really restrictive on their debt to income ratio. So that might reduce somebody's buying power by a lot. But then there's loan programs out there like Alaska Housing, which is a home opportunity program. They give a grant. We have lenders that have a down payment assistance, where they give up to 4% to go towards conventional loan programs. So if somebody qualifies, let's say for the Home Possible or Home Ready, which is 3% down minimum, that 4% will cover their down payment and 1% of their closing costs. And then there's the FHA Flex Loan Program, which is zero down. So it's similar to kind of like the Home Opportunity Program, which is like a silent second, depending on how long they keep it, or there's ones that they could actually repay back to the FHA loan. So for people, it's just a matter of asking the questions, because there's most likely a loan program out there that will help them, so they don't feel like they have to struggle just to get all of the ducks in the row.
Yeah. Yeah. And that's big. I mean, a lot of people feel like they have to have a specific thing before they get there. And, if the goal is just to get over the finish line, there's a lot of things that you can do.
Mhm.
Now it's up to, I feel like, the buyers to be able to look at their finances and know if the end result is something that is going to make sense for them and their family. Just because you can qualify for like 500,000 doesn't always necessarily mean that we want to go get like a $500,000 house and just max it all out. So yeah, I mean that's something I would just point out for people. There's we're gonna give you all the information, let you make your own decision, but ultimately at the end of the day, you need to sit down, look at your own finances, and really Amanda is going to be that person that you can talk to that's going to give you that clarity and help you decide if what monthly payment you're going to be able to make that you're going to be comfortable with. So
Yep,
yeah.
absolutely.
All right. So let's do some easy ones here real quick. Can someone get pre-qualified based off of an offer letter? Because this is a question I get from people quite frequently. A lot of you who are watching this are usually folks that are looking at moving up to Alaska, and obviously you're not working up here yet. So if you can get an offer letter, that's is that going to be a big deal? So Amanda, what say you? Can someone get pre-qualified based off of an offer letter?
They can. However, you want to make sure the offer letter is very just straightforward. If there's any sort of contingencies on that offer letter, that's typically what will trip people in underwriting. Let's say, or if it's temporary employment, you have to qualify. Your offer letter is based off of, meeting X, Y, and Z. That's where they want to make sure that X, Y, and Z have been met, to make sure that you're not going to have any hurdles, or they're going to say, never mind, you're not employed. But if they're pretty straightforward, you're golden.
Yeah. What are some contingencies that you see on offer letters that can be kind of disqualifying or make it so the offer letter is just not very usable?
Some of the main ones that I've seen are, especially for government offer letters, is like the background checks, drug checks, things like that. They're not as fast to do those. So those have typically held people up, with those background checks, or how extensive they're doing those background checks that take them a little bit. I'm not really sure what goes behind the scenes there. But you just want to make sure that you're talking with your employer, letting them know, like, hey, I'm trying to buy a house. They need to have these contingencies cleared up to make sure that I'm going to be fully employed.
Yeah. 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 Then that's really the trick. I've seen someone before. I've been in a deal where the lender wasn't aware the offer letter that they had was actually for a seasonal job.
Ooh.
And yeah, we were right there at the finish line, going to record in about a week or so, right around Christmas. And unfortunately, the entire thing just blew up, and we weren't able to close because it was a seasonal position.
Mm.
So I guess for people that are a little bit more seasonal, like how does it work for them with qualifying for a mortgage?
Most seasonal work, they do want to see, again, like a 2-year history of it, just because it's fluctuating. They want to make sure that they're coming back that following year. So they do typically want to see that 2-year consistency of seasonal work, because some seasons end sooner than the previous year, or they begin sooner. So it's not like a cut and dry. You typically don't start in March and end in, September. So
Gotcha. No, that makes sense. And okay, real quick, do traveling nurses, do they qualify as kind of those seasonal employees with kind of that same issue, or are they just a different category?
I've been able to, some lenders have looked at the traveling nurses, especially because they've gone to school for it, with their job contracts. And depending on how long that job contract is, even if it's for the year, they know that they're going to pick up more work. We've been able to get by with a year of traveling nurse income. So
Okay. Yeah, because I mean, just the traveling nurse thing in general seems a little bit more predictable and kind of fits into like the system a lot better than being a deckhand working on a ship catching salmon or something like that.
yeah, their season's not necessarily ending. It's consistent, and there's so much work out there for them.
Yeah,
They're always being busy.
absolutely. So we do have a question coming in from Mr. Turns Wrench. So how have rising rates impacted lenders selling off mortgage to other potentially lesser known lenders? Do buyers need to be concerned with mortgages being sold by their original lender?
That is a question I get often, and nobody can predict when a lender is going to sell off their mortgages. We have a lot of lenders, being a broker, that will typically try to keep the loans in house, but depending on their spreadsheet, they might batch some off and sell them. If it's a lesser, like, unknown lender, I know that could be kind of frustrating for certain people, but nothing can change within your loan terms. Everything has to stay the same. So it's not like they can really modify your actual loan. And if it's a lender that you're uncomfortable with, you can always have the option to refinance if it's in your best interest to. But any lenders at any time can batch and sell their loans off to different servicers,
Mhm.
unfortunately.
Gotcha. All right. So any other questions in the comments section, guys? Again, don't be shy about throwing them in there. For those of you who are watching on Instagram, trying to pop over there too. For some reason, that's our first time streaming on Instagram as well. It gets a little glitchy when I'm over there, so I'm doing my best to keep up with what's going on Instagram, but it's completely different. So let's go ahead and jump into one of our other programmed questions here. All right, come on. Give me just a second.
Need some Jeopardy music.
Yeah, I need to get some kind of music or something for the background. Man, my internet is slow tonight. And you know what? I think it might have something to do with it being like -20 outside.
I know that hasn't been helping. We lost power last night.
Oh, really? That's brutal.
Yeah. It was so cold in the morning. I was like, what is going on?
All right, we'll definitely make sure to circle back.
Yeah.
All right, so what is predatory lending and how can buyers identify a risky situation?
So for predatory lending, you just have to be cautious because there's a lot of lenders out there. And I'm sure people that already have mortgages, they might be getting junk mail, like flooding their inbox, their emails, phone calls saying, you're eligible for refinance. But you have to read the small print because they make it sound promising and super amazing. But when people get into it because they're like, wow, I want that 4% interest rate, they're not reading or getting directed to read all of the fine print with what comes with that loan. And a lot of times they end up with hefty discount points, lender fees. And lender fees are, we consider those junk fees where we work just because we don't have any lender fees, but they're called so many different names now. It's so hard to follow for a lot of consumers when they're trying to compare really what's honestly the best deal from them. And those lender fees, they can be named an admin fee, processing fee, underwriting fee, lender doc prep fee, origination fee. So those are just to name a few. And so you really want to be careful when people are flashing a really low rate and telling you to refinance or that they can do something amazing for you. If you have somebody who's in your corner that's knowledgeable and that can help guide you in the way of making sure that you're getting the best deal, you want to run those by that person that you have. I have people that I work with where they might say, hey, I got this in the mail. And as soon as we pull out that magnifying glass, it's always in the small print that they're like, wow, that's crazy. So it's just opening your eyes and making sure you're being just alert that there are going to be people out there that are trying to get your business, but it's going to come with a hefty price and you're not going to know it until it's probably too late. So if it seems like a really good deal, chances are that it's not a good deal for you. It's probably coming with a large cost. Talk to somebody that you know, like, and trust. That's a trusted advisor. That's somebody that can be in your corner that can actually help guide you and say, no, this is a bad deal. So
yeah. Do you have any examples maybe on like numbers, how much, what the cost can be for people if they slip into one of these deals where, it's not turning out to be exactly as it was advertised? And, can you, do you have anything like off the top of your head where you'd remember like how much it costs people to fall into one of those?
I recently had somebody that I helped. The husband had jumped on this VA this VA refinance, trying to do a cash out. Thought it was like an amazing deal. Wife had just unsettling feelings, so she reached out to me just because I helped them close on their loan. And she's like, I don't know. And I was so glad that they came to me because when she showed me that cost sheet, there was over $15,000 in fees.
Jeez.
It was
For a
crazy.
refinance?
For a refinance.
Wow.
So, and they just, once I opened their eyes on that and how long it would take them to actually recoup all of that, it was just, they pulled out. I'm like, this is crazy. So, just be careful. There's so much out there. If you're looking at, the lender fees, discount points, when people look at the lower rates, a lot of times I'm pointing out, I'm like, okay, they're coming with a hefty discount point. Like anybody can do that. You can buy your rate down, but you have to do the math as well. Like if you take the higher rate versus the lower rate, what's the difference that you're saving? And then divide that into the cost. That'll tell you how many months it's going to take you to recoup that. And if it's over, 2-3 years, you're probably going to pass. Because by then, even for people now that are locking in, they're most likely going to be in a position to refinance in a year.
Yeah, and that's a really good point because I had the option a number of times for properties that I've purchased where um, you'll get it and it's like, okay, well, you can have like, I think it's like a quarter point less or something like that, or 1 point. So I guess it was 1.5 or 1.6 or point one something, not 1.7. Okay. 0.16 or 0.17, something like that. And it's like, okay, this is going to cost X amount of dollars. And, it was broken down in a way that really made sense where I was like, okay, you're going to have to hold on to this for, I think it was like 8 years or something like that. It's like, you plan on holding on to it that long? Maybe yes, maybe no. Okay, well, it doesn't make sense. Just get the higher interest rate.
Mm-hmm.
And for me, from what I've noticed, like anytime like a lender just really leads with interest rate, or anytime you kind of feel that you kind of have that sense of like greed suddenly rising up in you, that's usually kind of a bad sign. Because I've been told like you're usually going to do something dumb when you feel like greed or fear like welling up. Anytime you feel either one of those things, you're probably going to do something dumb pretty quickly.
Yeah.
All right. So I'm sorry, go ahead.
I was going to say, just take a step back.
Take a step back, take a cold shower. If it still sounds like a good idea, then take a look at it.
Mm-hmm.
Actually, one question I did have, and this isn't in my notes or anywhere, but what are you seeing as far as like assumption loans? Because there was a hot minute where the interest rates were high and everyone was ready to go with this assuming loans and all that. Can you explain to people what they are and whether or not it's, what the pros and cons are?
So, assumption loan is essentially where you're taking over the previous seller's loan, their mortgage. And maybe they have a 2.5% interest rate. And with rates, if you can only get like a 6% interest rate right now, that's a good deal. And so when most people look at those assumptions, they get excited because they're like, we're going to get this loan, there's $300,000 left and it's going to be for 2.5% over 6%. Great. Sign me up all day long. A lot of times people don't understand that with those assumption loans, let's say the seller is selling the house for $400,000, they want you to assume their $300,000 loan. You have to come up with that difference of the $100,000 in cash, or a different line of credit or something. Not a lot of people have that type of money just sitting in their bank account because the lender is not going to loan it to you. And you can't get necessarily a second on the loan because it's not your property. So unless you have the cash to come up with the difference, a lot of times that doesn't work for somebody. The other thing to think of is the servicer, they already have that loan in their pocketbook. So they're not dedicated to giving you fast customer service. And a lot of times those assumptions can take 90 days or more to close, and they drag everybody through the mud.
Yeah, I'm working on one right now. We're supposed to be closing here in the next couple of weeks, and we put it under contract back in July. So that gives you an idea. Yeah, that gives you an idea how long of a time frame this is. Definitely not a quick closing. Yeah, I'm sorry. Go ahead.
No, yeah, and that just leads to my point is they're not dedicated to give you that fast customer service. They already have the loan. They're already getting paid monthly, And so that's the biggest headache that I think people come up against, is just how long it takes, and you're at their mercy. So the assumptions can be great in the sense of you're grabbing a lower interest rate, but you have to come with a large pocketbook to maybe cover that difference, and have a lot of patience in your back pocket, because they can drag out pretty long. So, and I've seen them fall apart more than often than not, where they end up just getting a regular mortgage. But you're dealing with that person servicer, so you're not even going through a traditional like loan officer like myself or anything like that. You're dealing with a servicing company.
Yeah, and again, I really want to emphasize as well what Amanda did there, that the servicer, the person who has the loan and you're assuming it from, really don't have a high level of motivation to make anything happen quickly, and you really have no ability to put pressure on them. And for a lot of people, that's just completely not what they're used to. They're used to having some level of control over the process, unless they, I guess, unless they've worked with foreclosures. But most people are used to having some level of control, and with assumptions, you don't have that. It's going to take a while. And like I said, we've got one that we're doing right now, and it's just very, very rare that you find a seller who can have that much time and to have a buyer who also has that flexibility in their schedule as well, and has the financial ability to make that work too. So it's I know on paper it just sounds like the best thing ever, but in reality it's very rare to actually be able to make one of these work.
Mm-hmm. Yeah.
All right, but yeah, sorry, side question there. Okay,
Good
so
one.
moving on here. What do you say to and these are just questions that I've seen recently just in my conversations with people, so I'm going to go ahead and pose them to you and see what you think. So, number one, what do you say to a couple who are not married and who want to buy a house together, though?
That I would say, what's holding you back from buying the house? So, people who are not married and want to buy a house together, there's nothing wrong with that. You're going to be looked at whether you're married or unmarried. Your income, your debts are both going to be on the application. And we have a lot of those people that don't believe in a conventional marriage and getting it on paper. They decide that they just are, lifelong partners, and there's nothing wrong with that. You guys will both be on title, you both be on the loan. So people who are not married and want to buy a house, buy the house.
Okay. Question number two. If someone is being pursued by collections, is there anything they can do to purchase a home prior to paying off that debt?
Yes, depending on the collections, this is where it's really beneficial to get pre-approved or talk to a seasoned loan officer who can help guide you on certain collections, maybe to focus on, because there are collection accounts out there that, like for example, medical collections. We don't look at those at all in the mortgage industry. So if you have medical collections, because they're like the easiest things that most people get, they're not going to pay attention to those one bit. I'm not saying go out and rack up medical debt, but if you have them on your credit, it's just something that we're not going to be paying attention to. And there are certain amounts of collections or charge-offs that we can get around. So if you have questions on your credit report, it's better to talk with a professional, a licensed loan officer like myself, where I love going over, people's credit, to really help them focus and guide them on what they really need to focus on. So that way they're not just paying off things hoping that it'll help their credit score. Because a lot of times people end up paying certain things off that they didn't necessarily need to pay off. And if it's in a derogatory account status and they paid it off, it's going to refresh that whole derogatory status stage and actually bring their credit score down. So,
Oof.
yeah, that's where I'm like, just be careful that you're not just going and just paying anything off that you think is a good idea, because it actually might hurt you more than help.
Man, that's wild.
Yeah.
Okay. Got a question from Mr. Turns Wrench here. How complicated could the lending get if you finance vacant land and then need to refinance the home build thereafter? So kind of sounds like a building loan. So what do you think?
Yeah, so we actually have a lender that does these types of loans. It's a one-time close. So sometimes people already own the land and then they're dealing with a builder to basically build the home in stages where they give the draws, the borrower's the one paying the interest on the draws so that the builder doesn't have that much risk. And then they just turn it into long-term financing. So you close all at once. Whether if you own the land, it's considered a refinance. If you're having the land bought and the home built, then it's considered a purchase. But if you own the land and you're not necessarily using a one-time close, you're doing it yourself and you're trying to get the equity, that would just be like a cash out refinance. So
Roger that. So, anecdotally, are you seeing more or less loans being originated this year, kind of in like the first month? I know it's super early, but kind of in the first month compared to last year. I mean, obviously, what it feels like anecdotally, obviously subjective, but what are you feeling as far as that goes?
I would say this year, it I think we had a slower start, but we're starting to pick back up. I'm seeing a lot more applications come in. And I think that was just with the turn in the market, with people saying the rates are coming down. So that's getting some buzz out there and getting people excited.
Yeah. No, I can definitely yeah, I can definitely echo that. I've kind of seen a bit more of that the past couple of years. Like I think last year, actually, we had like the lowest number of actual sold properties, like really in recent history, just because the inventory was so compressed. And so even just seeing like a bunch of people kind of gearing up, that's a good sign. But it's all going to come down to what happens as far as the inventory does.
Yeah, and I would say like last year, I know we had quite a few applications, but there was just nothing that people could purchase. They were just, I think they just kind of gave up. A lot of people were kind of pulling back and just waiting.
Yeah. And I mean, in these kind of markets where there's not a lot out there, usually the best thing I can tell people is just say, okay, well, this is just a lifestyle for us until we can actually make something stick. So we're going to look at properties. We're just going to be like mentally and emotionally ready for see a house we like, go make an offer, it not get accepted, multiple offer situation, somebody else got it. Okay, on to the next one, and so on and so forth. And that can be very difficult for some people because, you know, whether you want to or not, you get emotionally invested in like a house when you're making an offer on it
Yeah.
and not being able to get it. I mean, I've been there before, crushing. Believe me, like actually, remember one time I went $75,000 over asking price, offered a $20,000 appraisal gap, which means like if the property doesn't appraise for like this over $75,000 that I'm asking for, then out of my own pocket, I'll put down an additional $20,000. And like I was all in and I did not even get a counter.
Oh my gosh. Dang. Yeah, that's
Yeah. So believe me, I get it.
yeah. And I think a lot of people too, if this is their first home, like you gotta don't beat yourself up. Like it's not your forever home, most likely. So sometimes people have this like idea like they're gonna get like the perfect home. I remember my first home. That's like a long time ago. My realtor was like, "This isn't your forever home." So just try not to focus on the long term. I'm like, "No, you're right. This isn't going to be my forever home." So. Um, just keeping that in the back of your mind as well when you're out there shopping, especially if it's your first home and it's not going to be your forever home. Don't be scared to settle on some things, but make a list of like the absolute must-haves with the house and stick with it.
Oh yeah, absolutely. And I mean something else that I would say also, try to make sure you don't weight every single variable in the house with exactly the same weight. In other words, the number of bedrooms, the square footage, the size of the pantry, the way the property is pointing, the color of the railing of the front porch, all those need to be weighted differently. Like I've seen some people before as their first house, and every single detail like that was exactly the same importance. And as someone who's been down this path before, like someone who's bought 2 or 3 houses, they'll tell you, yeah, you need to have some priorities and what's important. And I'm not going to say let the rest go, because obviously it's not nothing, but keep it in perspective.
Yeah.
All right. So, folks, we are about 10 minutes out here. So if you have any final questions, concerns, objections, anything like that, then this is going to be your final call. Make sure you get those questions in, and we will get those answered for you. So we kind of talked a little bit about this before, but kind of projections for the interest rates, we're looking at probably about that possibly. Obviously, we don't know for sure, but some of the projections are interest rates like low 5s, upper 4s.
Yep. Well, and I mean, depending on the loan program. So like VA, FHA, they might be in the low 4s.
Gotcha.
So because those government loan programs typically are lower than conforming conventional loan programs, but that's because they also have those funding fees that typically get wrapped into the loan. So they offset it that way.
Gotcha. All right. So let's do our final 2 here. When people want to buy a home, what are 3 top things they shouldn't do as they're getting themselves ready to purchase the home?
So the 3 top things I would say, don't go changing your jobs, something drastic. If it makes sense to take a new job, maybe just wait, talk with a professional, a loan officer, where they can help guide you in that sense. Because if you're going from a W-2 wage to a 1099 or self-employed, that's not going to work. So if you're wanting to buy a house, you want to make sure that you have stable income and you can show that. Now if it's the same line of work and you're actually going to a company that's going to also be the same line of work, same type of pay, W-2 employee or anything like that, but it's going to be better pay, then absolutely I would say go. But most people, there are a handful of people out there that will try to change up jobs in the midst or before, that ends up tripping them. And then I would definitely say, be careful with your credit. Don't go racking up credit card debt or grabbing new debt. Don't go out and buy a brand new vehicle and finance it. That's really going to hurt you in the long run. And if you own a house, or you're renting, depending on the loan program, they might need that history of that to make sure you're making those payments on time. So. And I would say something else. I know this, you said the top 3 things, but don't try to spend everything that you've saved. Maybe hold on to some of that, the savings.
All right. All right. Amelia, can you hear me?
I know.
Okay.
Like, you go. Oh, I can't hear you. No. I can read that, but 3 things you can do today to prepare. So 3 things that you can do to prepare for buying a home. The positives would be budgeting, like figuring out like your overall budget. It's really important when I get somebody in front of me and I'll ask them like, hey, what are you trying to spend monthly on a mortgage payment? A lot of times people don't know, and they don't even know where their overall budget is sitting. So go home, write down all of your bills. If you like to go to the movies or bowling every Friday or go out to eat every other day, you want to factor that into your budget. So when you're buying a house and you add a mortgage payment on top of all of that, you're not, suffering in the fact that you're going to be just working to pay a mortgage. You still want to enjoy life and do the things that you liked to do before you bought a house. So make sure you're budgeting wisely. and taking that in consideration, and then adding a mortgage payment on top of that, so you're comfortable within your overall budget. And then paying off debts. So that's the opposite of the other one I just said. Pay down credit cards, as much as you can, as you want. Again, you don't have to do this before you apply, but if you pay your debts off once a month, just be mindful of when your creditor, whoever whether it's Bank of America or whatnot, when they actually report to the credit bureaus, or when they cut that statement to report, you typically want to pay that credit card down or off a week or two before they actually cut the statement to send to the credit bureaus. So it looks like your low usage on that credit card. You always want to be below 30% of the credit card usage. And then the other one, like just be mindful of, keeping your job the same. If you're working 40 hours, work 40 hours. Try not to take a whole lot of time off, because when you reduce those hours, when we get pay stubs and things, if they're less than 40 hours, it can sometimes trip us in underwriting, just because they're looking at your overall, and they might have questions. So making sure you're working your full time